Major changes are being made to the banking environment right now, and the reason so many people are confused is that they keep looking for one dramatic law instead of looking at the whole direction of travel. That is the first mistake. People want a single villain, a single new rule, a single press conference that explains why moving money suddenly feels harder, why banks ask more questions, why some transactions get delayed, why dormant assets get swept into state systems faster than people expect, why cash is less welcome in parts of the world, why account monitoring feels tighter, why wealthy people keep quietly diversifying where they bank. It is not one change, it is a pressure system. That is what I want you to see, because once you understand it as a pressure system, a lot of the fear turns into something much more useful. It turns into strategy. I am not interested in conspiracy theories. I am not interested in panic. Panic is a terrible banker, but I am very interested in how the modern banking system actually works, because a person who understands the machinery can protect himself far better than the person who keeps telling himself that banks still behave the way they did 20 years ago. They do not. The modern system is more monitored, more automated, more compliance driven, more cross-border in its information sharing, and less patient with anything that falls outside the pattern a bank wants to see. That is not a moral statement. It is an operational statement. And if you are serious about protecting your money, operational statements matter more than moral ones. Let me start with the first issue people keep talking about because it is one of the few that most people have at least heard of. Bail. A lot of people hear that phrase and imagine the government can simply raid everyone's checking account the moment a bank gets into trouble. That is not the right way to think about it. But the underlying concern is real enough. What changed after 2008 was that regulators around the world became far more determined not to repeat the same taxpayer, funded rescues in the same way, resolution regimes were redesigned, losses are supposed to hit shareholders first. Then certain creditors, in some systems, large uninsured deposits can also be exposed because anything above the deposit insurance limit is, in plain language, a claim on the bank rather than a sovereign promise to you that distinction matters. In the United States, FDIC insurance still protects deposits up to at least $250,000 per depositor, per insured bank, per ownership category. And the FDIC says uninsured funds above that limit become claims against the failed bank's receivership that may take time to recover and may not be fully recovered. In 2023, the uninsured depositors at Silicon Valley Bank and Signature Bank were protected only because regulators invoked the systemic risk exception, and the FDIC later imposed a special assessment on large banks to recover that cost. That was not the ordinary rule. That was an extraordinary intervention. Faysite Fayturn 334,930 view 0 Fayturn 708953 search 3 Fayturn 708953 search 708953 search 10. That is the reality most people do not want to face. Deposit insurance protects a lot. It does not protect everything. And if your banking strategy depends on believing that every dollar in every account is equally safe regardless of amount, you do not have a strategy, you have a comforting story. Now, I am not telling you that every wealthy person should run around spreading cash between 20 different institutions like a fugitive. What I am telling you is much simpler. You should know exactly what is insured, what is uninsured, and what category the money sits in. That is adulthood in modern banking. The second issue is dormancy and unclaimed property. This is one of those subjects people dismiss until it touches their family, and then suddenly it becomes very real. Most people assume that if they forget an account for a few years, the bank will just keep it there waiting faithfully. Sometimes it will. Sometimes the law requires something else, dormancy and unclaimed. Property rules vary widely by jurisdiction, and what matters here is not some romantic idea of how banks ought to behave. What matters is what local law requires once an account sits inactive long enough. In the United States, this generally becomes a state unclaimed property issue after periods that vary by state and asset type. In Australia, the rules changed several times over the last decade, but ASIC's current guidance says inactive bank accounts generally become unclaimed after 7 years. Not 3 in the UK. The dormant assets scheme has expanded well beyond its original bank account scope into insurance and pensions, investment and wealth management, and securities. Faysite Fayturn 708953 search 1 Fayturn 478,667 search 2 Fayturn 478,667, search 1 Fayturn 478,667, search 3 Fayturn 478,667, search 13 Fay. That is the first practical lesson. Do not rely on vague memory for inactivity periods. Know them. And if you are managing family money across generations, this matters even more because older relatives often have forgotten accounts, old insurance balances, legacy savings products, or minor holdings that nobody has looked at for years. The problem is not only losing access, the problem is that once money moves into an unclaimed property or dormant asset system, reclaiming it can become slow, bureaucratic, and emotionally exhausting at exactly the moment your family may already be dealing with illness, death, or estate confusion. That is why I dislike the lazy assumption that dormant account rules are no big deal because you can always get it back. Maybe, but the process is the punishment. And avoidable bureaucracy is one of the most expensive forms of stupidity in finance. The third issue is asset freezing without conviction. This one makes people deeply uncomfortable because it sits right at the intersection of law, power, and ordinary innocence. Most citizens still assume the state must convict you before it can seriously interfere with your property. In some areas of banking and financial enforcement, that is not how the world actually works. Civil asset forfeiture exists. Account freezing exists. Tax freezes exist. Anti-money laundering inquiries can create practical paralysis long before guilt is established in any dramatic courtroom sense. That does not mean the law is always being abused. It means the threshold for disruption is lower than the average innocent person imagines. I think this matters because once you understand that, accounts can be frozen as part of investigations, not only after convictions. You stop asking the wrong question. The wrong question is, did I commit a crime? The more relevant question is, could my activity or my counterparties create a compliance event that interrupts my access to funds while the system sorts itself out? That is a much better question. And once you ask it, you start behaving with more foresight. You keep records. You separate personal from business flows. You document sources of funds. You avoid weird transfer patterns. You become easier to defend if anyone ever has to defend you. The fourth issue is capital controls. Most people in developed countries still talk as if capital controls are some exotic affliction that only hits badly managed emerging economies. History says otherwise. Cyprus used them, Greece used them, Iceland used them. In each case, the existence of money in the bank did not mean free access to that money under stress. That is the psychological trap. People confuse ownership with liquidity. The two are not the same. If controls arrive, what matters is not only whether you own the money, but where the money is, what currency it is trapped in, what transfer routes are still open, and whether you built any flexibility before the controls showed up. This is one reason why wealthy families think about jurisdictional diversification far earlier than ordinary households do. They are not necessarily trying to evade anything. In many cases, they are simply trying to avoid single jurisdiction fragility. If one place imposes restrictions, another place may still give them operating room. Now, I am not telling the average person to rush offshore because of tomorrow's headlines. That would be silly. But I am telling you that if every meaningful dollar you have is trapped in one country, one bank, one legal system, and one policy regime, then you are more exposed than you think. That is just mathematics. The fifth issue is investment and asset restrictions. People tend to notice this one only after it hits them personally. They imagine the main threat to capital is loss. Sometimes the threat is narrower but still powerful. You are no longer allowed to hold, move, or use certain assets in the same way you once assumed. Tax rules can make foreign pooled investments awkward or punitive. Stablecoin rules can tighten. Crypto reporting can expand. Cross-border transfers can trigger more screening. Cash purchases can face tighter limits. The point is not that all governments are marching in lockstep. They are not. The point is that financial freedom is increasingly conditional on policy architecture that most citizens barely read. That is a bad combination, because when you do not know the rules, every minor change feels isolated. In reality, these changes accumulate. A restriction here, a reporting rule there, a new form, a new threshold, a new questionnaire, a new flag. Each one by itself can look manageable together. They create a financial life that is much less free-moving than the one people thought they still had. The sixth issue is currency debasement and the debate around central bank digital currencies. Now, let me be careful here because this is where people stop thinking and start hallucinating. Currency debasement is not a theory. If inflation outruns the interest you earn on deposits, your real purchasing power falls. That is ordinary arithmetic. CBDCs, however, are not all in the same place. Some jurisdictions are researching them, some are piloting them, some are advancing project stages, and some are far from launching anything that looks like a full retail reality. For example, the ECB continues to say that a digital euro would complement cash, not replace it, and that no final issuance decision has been made by lawmakers. The Bank of England has also repeatedly said that no decision has been taken to introduce a digital pound. Faceit Fayturn 539,513 search 0, Fayturn 539,513 search 3, Fayturn 539,513 search 6, Fayturn 539,513 search 9 Fay. Why does that matter? Because intelligent concern is not the same thing as lazy exaggeration. The real issue is not that CBDCs are already here controlling every coffee you buy. The real issue is that once a state has a programmable digital currency architecture, the policy options available to that state widen. Whether those options ever get used depends on politics, law, and public tolerance. But as a thinking person, you should notice the menu expanding even before a single dish is served. That is what the wealthy notice. Not the certainty of one future, the optionality of the state. The seventh issue is tax authority reach. Every developed country has mechanisms for tax collection, liens, freezes, and enforcement. International information sharing has widened through FATCA, CRS, and other treaty structures. People who imagine that opening one foreign account gives them magical invisibility are living in a fantasy that expired years ago. That said, there is still a big difference between legal transparency and operational vulnerability. You can be compliant and still overexposed. You can be properly filed and still make it too easy for an aggressive authority or an overreactive institution to disrupt your access to funds. This is why competent people distinguish between tax compliance and asset protection. They are not the same topic. Paying taxes correctly does not automatically mean your banking setup is resilient. And a resilient setup does not require tax evasion. It requires planning. The eighth issue is transaction monitoring. This is already everywhere, and it is becoming more behavioral, more AI-driven, and less dependent on old simple thresholds. A lot of ordinary people still think the main line in the sand is $10,000. That is naive. Banks file suspicious. Activity reports well below formal thresholds when patterns look strange. Financial intelligence systems in the US, Canada, Australia, the UK, and the EU all rely heavily on institutions noticing patterns, not merely single giant transactions. That means your problem is not only size, your problem can be shape. A strange pattern can matter more than a large transaction. An unusual wire to a new country can matter. A burst of account activity after years of silence can matter. An elderly client suddenly moving money in a way that departs from their normal behavior can matter. And because institutions are increasingly judged on whether they missed something rather than on whether they inconvenienced you, the bias of the system is obvious. They would rather stop the wrong person late than let the wrong transfer pass early. Once you understand that, a lot of your banking strategy should change. You warn your bank before unusual transfers. You keep purposes documented. You know your counterparties. You stop assuming that nothing illegal here is enough to make the transaction frictionless. The ninth issue is de-risking. This one is infuriating because it often has little to do with wrongdoing and a great deal to do with your profile fitting poorly into a bank's comfort zone. Banks do not need to love complexity. In many cases, they simply close it. If your pattern looks international, politically exposed, crypto, adjacent litigation, prone or otherwise higher friction than the bank wants, the bank may decide the relationship is not worth it. That is the brutal truth. The modern bank does not owe you romance. It owes you terms of service. And when your profile no longer fits the model they want, the account can disappear far faster than most people imagine. This is why choosing a bank is not only about yield, an app, or branch proximity. It is also about whether the bank's risk appetite matches your actual life. If your life is international and your bank is provincially cautious, do not act surprised when the relationship turns brittle. The 10th issue is the shrinking space for cash. Now here again I want to separate emotion from reality. Cash is not banned everywhere. Some countries still protect it strongly, but there is no doubt that restrictions on cash use have widened in parts of Europe and that the EU's anti-money laundering package is moving toward a union-wide maximum cash payment limit of €10,000 from 2027, while individual member states can keep stricter national limits. France remains much stricter already, with residents generally limited to €1,000 cash payments in many consumer situations. Faceit Fayturn 539,513 search 5 Fayturn 539,513 search 8 Fayturn 539,513 news 30 Fayturn 539,513 search 13 Fay. This matters for two reasons. First, law is one thing. Second, banking culture and merchant policy are another. You may live somewhere that still legally allows a form of cash use, but find in practice that merchants, platforms, and institutions increasingly make cash awkward or unwelcome. The formal right means less if the operating environment keeps narrowing. That is why older people often feel the squeeze before younger people do. They were trained in a world where cash meant independence. Now they are told that digital convenience is progress, while every layer of the new system produces more data, more conditions, and more surveillance than the old one ever did. I understand why that feels like a loss in many ways. It is, but the solution is not nostalgia. The solution is adaptation. So let me tell you what I would actually do. I would not build my financial life around fear. Fear makes people do stupid things. It makes them hide cash badly. It makes them trust bad operators who promise secrecy. It makes them concentrate everything in one safe place because they are emotionally exhausted. I would build around resilience. First, I want insured limits understood and respected. That means knowing how much of my deposits are actually covered and where my uninsured exposure sits. Second, I want jurisdictional and institutional diversification where it is justified by the size of the balance and the complexity of my life. Not as a stunt, as a hedge against single-point failure. Third, I want clean records. Every unusual transfer, every large payment, every source of funds, every beneficial owner, every power of attorney, every family arrangement that touches money. Fourth, I want to warn my institutions before unusual activity, instead of letting a machine discover it before a human. Here's the explanation. Fifth, I want at least one relationship with a bank or platform that is comfortable with the actual shape of my life, not the shape of a generic retail customer. Sixth, I want to reduce avoidable dormancy by touching long, idle accounts, consolidating where appropriate, and making sure heirs actually know where assets are. And finally, I want to stop assuming that because I have done nothing wrong, the system will always treat me as frictionless. That assumption is too old for the world we are in. The wealthy understand something that ordinary people often learn only after getting hurt. A bank is not a vault that passively guards your property with perfect loyalty. A bank is a regulated institution with incentives, obligations, fears, software, counterparties, and legal reflexes. The more you understand those incentives, the less likely you are to become collateral damage inside them. That is why I do not see modern banking as something to panic about. I see it as something to engineer around. And if you do that well, the 11 pressure points I just walked you through stop being a list of threats and start becoming a checklist for how to build a more durable financial life. That is the real objective, not escaping the system entirely. Understanding it well enough that it stops being able to surprise you in ways that matter. That is how you protect your money. Now, not with fear, with design.